MSCI keeps crypto treasury companies and indexes for a strategic win. Quick read below. Save or share if useful. Introduction. MSCI's recent decision to keep crypto treasury companies in its indexes is a small move with big implications. In an industry quick to draw lines, the global index provider chose nuance over exclusion. This episode walks through what MSCI announced, why it matters, and how it might reshape the relationship between digital assets and traditional finance. A win for strategy. MSCI announced it will continue to include companies that hold digital assets on their balance sheets, so-called crypto treasury companies, in its indexes. That choice bucks the simpler route of removing those firms and signals a strategic approach, study and engagement rather than reflexive exclusion. For investors and the broader market, that's a meaningful endorsement of treating these firms as part of the evolving financial landscape. Investor feedback mattered. One reason MSCI stayed the course was investor feedback. Large index providers regularly consult clients and market participants before making classification changes, and MSCI heard enough support to pause and reassess. The takeaway is clear. Institutional input can shape index rules, and today's investors increasingly want exposure to firms with meaningful crypto holdings, if handled transparently and consistently. What are non-operating firms, and why are they tricky? Crypto treasury companies often don't derive revenue from crypto operations. Instead, they hold digital assets as reserves. That creates a classification challenge. Traditional index frameworks are built around operating businesses, companies that earn money through products and services, so firms that hold significant crypto reserves blur the lines. MSCI's choice to research these firms further recognizes that new asset types demand new thinking rather than old categories force-fit to modern realities. Redefining inclusion in global indexes by keeping these companies in its indexes for now. MSCI is signaling a more inclusive, forward-looking stance. Index inclusion matters. It affects passive flows, visibility, and how institutional investors measure and access exposure. This approach could encourage other index providers to develop more nuanced rules for how balance sheet exposure to crypto is treated in mainstream benchmarks. What this means for traditional finance. Integrating crypto treasury firms into traditional indexes can expand investor access to digital asset exposure through familiar vehicles. That doesn't mean a free pass. Index providers still have to ensure consistent classification, disclosure, and risk treatment, but it does move the needle toward recognizing crypto-related balance sheet strategies as a legitimate facet of corporate finance. A pragmatic step forward. MSCI's decision is pragmatic. Listen to investors, study the complexities, and avoid hasty exclusions. It's a reminder that the financial industry is adapting to new forms of value creation, and that meaningful change often starts with careful analysis rather than headline-driven reactions. Closing this development won't settle every debate about crypto and indexing, but it's an important marker. Major institutions can respond to innovation with curiosity and process, not just caution. Keep an eye on how MSCI's further study and peer responses shape index rules in the months ahead. Follow and connect Twitter at @0_Simone_0 YouTube. Audiobook free. Author Ciro Msci Instagram at Spartaco_94_. Explore my other blogs. Tech Trend Spins. Blogspot.com. Fitness Home Journal, Fitness Home Journal. Blogspot.com. Pet Care Inspo, Pet Care Inspo. Blogspot.com. Nomad Vibes Board, Nomad Vibes Board. Blogspot.com. Crypto Radar Board, Crypto Radar Board. Blogspot.com. Green Planet Pins, Green Planet Pins. Blogspot.com. Healthy Eats Board, Healthy Eats Board. Blogspot.com. Enjoyed this post. Share it or explore more across my blogs and channels.